Hello and welcome to week 9 of Business Economics. In this unit we'll explain and discuss the foundations of money as a medium of exchange, discussing why money was created in the first place and how money is transacted in the economy. In particular, we'll review one of the most important monetary theories in economics, the quantity theory of money. Combined with the equation of exchange, both ideas have formed in one way or another the most integral part of orthodox monetary thought for nearly 300 years. We'll also discuss how interest rates are determined and the impact that interest rates have on bond prices. Finally, we'll consider the role that innovation and technology has played in the finance sector, specifically looking at how commercial banks have circumvented regulatory control and created their own forms of money through securitization and other means to expand the level of credit in the economy. Like most economies, Australia has a fractional reserve banking system, in which only a fraction of the total money supply is held in reserves as currency. The most significant factor about a fractional reserve system is the ability by the commercial banks to create money with their deposits. When we refer to money being created, we are referring to money, credit and finance available in the economy that is not backed up by physical assets such as deposits, gold or indeed government bonds. In the absence of financial regulation, banks can continue this process as long as they have enough reserves to meet the daily cash requirements of its customers. Of course, this represents the biggest risk for banks. What would happen if all depositors decided to withdraw their money from the bank at the same time? Well, this is commonly referred to as a bank run. The equation of exchange offers the following relationship, and that is MV equals PY. In its simplest form, the quantity theory of money regards output as being determined by the productive opportunities of the community and its tastes and preferences. It regards the quantity of money as being determined by the conditions of production of the monetary metal plus the characteristics of the financial and banking structure. And it also regards velocity as being determined by the payment practices, the financial and economic arrangements for effecting transactions, and the costs of and returns from holding money instead of other assets. And finally, it regards the price level as the variable that adjusts to reconcile the conditions of production. There are three main economic theories on the determination of interest rates that we'll be looking at. The first is the Fisher theory, the second is the loanable funds theory, and the last is the liquidity preference theory. In the last section of the unit, we'll explore the notion that a significant portion of the expanding supply of credit money finance across most modern economies over the last 3 decades can be attributed to the existence of what we call endogenous money. It is believed most monetary authorities, including the Reserve Bank of Australia, has little influence over commercial banks' innovative techniques to increase their lending sheets. There is, in effect, a cat and mouse game between the commercial banks and the central bank, with commercial banks innovating, central banks regulating, and commercial banks innovating to circumvent central bank regulation.